Once in a while, a company's earnings report tells a story that's way more than just numbers. It's a story about a major shift, about big challenges, and about a clever strategy. Today, we're diving deep into the Q4 2025 report from IRIX, a company that's sitting at a really fascinating crossroads. So, let's get right into it. So, first off, who exactly is IRIX? Well, they're a medical technology company that works in a super specific and pretty high stakes field. Ophthalmology. Basically, they create and sell these cutting edge laser systems that doctors use to treat serious eye conditions, things like glaucoma and diseases of the retina.
All right, so to really get what's going on with them now, we have to look back at 2025. And this wasn't just a good year for IRIX. It was a full-blown financial comeback, a really transformational one.
And hey, you don't have to take my word for it. The company's own president and CEO, Patrick Mercer, laid it out this clearly. I mean, this one sentence really sets the stage perfectly. It hits the three key things they pulled off. They grew sales, they slashed costs, and they hit a major profitability goal. So let's break that down. First up, revenue. For the whole year, they managed to grow their sales by 8%, which brought them to $52.7 million. In a market this competitive, that kind of growth is a really healthy sign. But here's the part that makes this story so interesting. While that revenue number was climbing, their operating expenses, the day-to-day costs of just running the business, were going down. And I mean really going down. A 22% cut shows some serious discipline. So what happens when you're making more money and spending less? You hit this. This is a huge milestone. By the end of the year, IRIX wasn't just selling stuff, it was actually bringing in more cash than it was spending. For any company trying to turn things around, becoming cash flow positive is a massive turning point. The CEO also mentioned hitting positive adjusted EBITDA. So, what on earth is that? Well, to put it simply, it's a way to look at how profitable the company's main business is without all the noise from things like taxes or accounting rules. Hitting that positive number for the first time in a while means that in 2025, their core business of just making and selling their products actually became profitable. Okay, so these financial wins didn't just appear out of thin air. They weren't just numbers on a spreadsheet. They were powered by real products and some serious momentum in the market. So let's take a look at what was actually driving all that growth. So IRIX's business really boils down to two main areas. On one side, you've got their glaucoma products, and the star of that show is the Cyclo G6 system. On the other side is their retina business, with the Pascal system as their big flagship product. And the thing is, both of them were doing really well. Now, this number is actually more interesting than it looks. They sold almost 58,000 of these Cyclo G6 probes. And these things are consumables. They get used once and then thrown away. This creates this awesome recurring revenue stream. Think of it like the classic razor and blades model. The more systems they get into hospitals, the more of these probes they're going to sell year after year. And it wasn't just the glaucoma business firing on all cylinders. The retina side of the company had a fantastic end to the year. Their revenue shot up 22% in the fourth quarter alone. This was mostly because they sold a lot of their Pascal systems, which just goes to show that both engines of the company were really humming. So, fantastic comeback story, right? Revenue's up, costs are down, their products are flying off the shelves. It sounds almost too good to be true. But, like any good story, there's a plot twist. Yeah, if you dig a little deeper into that earnings report, you start to see a couple of pretty big challenges that kind of put a damper on the celebration. And they really set the stage for what the company has to deal with next. And this chart right here shows you the first major problem perfectly. What you're looking at is the company's gross margin, and you can see it took a pretty nasty hit, falling all the way from 44% down to 37% in just 1 year. So why is that such a big deal? Well, gross margin basically tells you how much profit a company makes from each dollar it earns in sales, before you even account for other business costs. A drop from 44 cents on the dollar down to 37 cents? That is a serious hit to your profitability, right at the source. So what happened? Well, the company pointed to a few different things. For one, their manufacturing costs just went up. They also got hit by tariffs, which made their products more expensive to make. Then there were some, let's call them accounting effects from having less inventory, plus the impact of some write-downs from earlier in the year. It's really a mix of both internal and external pressures. And the second major challenge is geopolitical. IRIX came out and said that their financial forecast for 2026 just assumes zero sales from the Middle East because of all the conflict in the region. And that's not chump change. We're talking about 5% of their total revenue, just gone from the forecast. So you have this great turnaround story that's now running into some serious headwinds. Profits are getting squeezed on every sale, and a geopolitical mess is about to wipe out a whole chunk of their market. So, what's the plan? Well, management laid out a really clear multi-year plan that's all about attacking their costs. First, they're moving a bunch of their administrative jobs out of pricey California. Second, they're relocating their entire corporate headquarters. And the big one is they're shifting their manufacturing over to third-party partners to get those product costs down. And look, these aren't just some vague ideas. Just that headquarters move by itself is expected to save them around $600,000 a year. This is them directly fighting back against that margin pressure we just saw. On the growth side of things, the plan is just as clear. They are basically doubling down on what they know works. They're going after the busiest surgeons to get them to use the G6 system. They're trying to get their current customers to use it even more. And they're pushing clinics to upgrade to their newer Pascal systems, all while trying to get approval to sell in new countries. So if we step back, here's the big picture. 2025 was the year that IRIX finally got its own financial house in order. They proved they could grow sales while cutting costs like crazy. But 2026 is shaping up to be a whole new test, one where they have to deal with these outside pressures that are squeezing their profits and closing off entire markets. And that really leaves us with a big question for the year ahead. IRIX has a solid plan, and they've shown they know how to execute. But in a world with rising costs and unpredictable conflicts, is that internal discipline going to be enough to keep this comeback story going? That's what we'll all be watching.